This is Wednesday, February 18th, 2026, and in the last 72 hours, something happened at the COMEX that I have not seen at this scale in years. 12 million ounces of silver were drained from COMEX registered vaults. 12 million ounces. Gone. And while that was happening, the spot price of silver dropped from $35.40 down to $34.80, 60 cents, in a matter of hours. $600 million worth of metal walked out the door, and the price went down. If you are watching this right now and that sounds completely normal to you, I need you to stop, take a breath, and watch this entire video because what I am about to show you does not make any sense. The numbers do not add up. The story the market is telling you is not the real story. And if you leave this video right now, you are going to miss the single most important thing happening in the silver market today. Here's what you need to understand right now. COMEX registered inventory just dropped to its lowest level since October of 2021. The silver lease rate spiked to 4.3% overnight, the highest reading in 14 months. The U.S. Mint has suspended Silver Eagle allocations for the third time in 6 months. Industrial delivery premiums in Shanghai are running 6.8% above London spot, and physical silver dealers across the United States, Canada, and Australia are reporting wait times of 3 to 6 weeks for 1 ounce rounds. Let me say that again so it sinks in. 3 to 6 weeks for 1 ounce of a metal whose paper price just dropped. The price is crashing, but you cannot buy the product. Does that make sense to you? Does that sound like a real market? In any normal market, when supply drops and demand surges, prices go up. That is economics. That is not complicated. That is what every textbook, every professor, every analyst on television will tell you. Supply goes down, demand goes up, price goes up. That is the rule. Except right now, in the silver market, that rule does not apply. And that should terrify you, or it should wake you up, because something is very wrong. And by the end of this video, you will understand exactly what it is, exactly who is doing it, and exactly what you should be doing right now. My name is on this channel, and if this is your first time here, what we do is look at the data other people ignore and connect the dots other people are afraid to connect. Hit that subscribe button and turn on notifications, because this is the kind of analysis you will not find anywhere else. A few days ago, I made a video. In that video, I told you to watch the COMEX registered inventory number because it was sitting at a critical threshold near 280 million ounces, and any break below that level would signal extreme physical stress in the system. I told you the paper to physical ratio was dangerously elevated and that the banks holding short positions were running out of room. I told you the industrial demand from the solar sector alone was going to create a supply crunch that the market was not pricing in. And I was right. But here's what I did not expect. I did not expect the drain to happen this fast. 12 million ounces in 72 hours is not a slow bleed. That is a hemorrhage. I did not expect the lease rate to spike above 4% this quickly. That number moving that fast tells you something specific about what is happening behind closed doors. I did not expect 3 separate major dealers, 2 in the United States and 1 in Perth, to suspend or severely restrict sales within the same 5-day window. And I did not expect the Shanghai Futures Exchange to post a 6.8% premium above London spot at the exact same moment the COMEX was being drained. All of that happening simultaneously in the same week is not something I predicted with that degree of precision. And that is exactly what we need to talk about. Let me explain how the silver market works, because most people do not understand this, and that misunderstanding is costing them money. Pay very close attention here. There are essentially 2 silver markets operating at the same time. They are connected, but they are not the same. And the gap between them is what tells you everything you need to know about what is real and what is fiction. The first market is the paper market. This is the COMEX in New York, the LBMA in London. This is where contracts are traded. Futures contracts, options, derivatives. On a given day, the COMEX trades the equivalent of roughly 800 million ounces of silver. Let that sink in. 800 million ounces on paper. The entire world mines approximately 820 million ounces of silver per year. So in a single trading day, the paper market trades a volume roughly equal to everything the entire planet digs out of the ground in 12 months. The paper market is like a giant poker game, being played with chips that are supposed to represent silver, but most players at the table will never actually pick up a single bar. They are trading the idea of silver, the promise of silver, the paper representation of silver. And because there are so many of these chips in circulation relative to the actual metal, the chip price, the paper price, can be pushed around by large players almost at will. The second market is the physical market. This is the real one. This is Perth Mint, the Royal Canadian Mint, the US Mint, the refineries in Switzerland and Japan, the dealers in Texas and Singapore and Dubai. This is where actual metal changes hands. And this market is telling a completely different story right now. Here's what you need to understand. When those two markets diverge, when the paper price says one thing and the physical market says another, one of them is lying. And it is not the physical market. Now let me show you the evidence. And I want you to pay very close attention to what each of these data points means individually, and then what they mean together. COMEX registered inventory as of February 17th, 2026, sits at 267.4 million ounces. That is down from 279.6 million ounces just 8 trading days ago, a drop of 12.2 million ounces. Now, registered inventory is the metal that has been specifically designated as deliverable against futures contracts. It is the metal the COMEX has committed to hand over if someone stands for delivery. When that number drops this fast, it means one of two things. Either large players are pulling their metal out of the COMEX system entirely, which means they do not trust the system to hold it, or large players are taking delivery on contracts and physically removing the metal. Either way, the metal is leaving. Let that sink in. Perth Mint in Australia, one of the largest and most respected sovereign mints in the world, issued a product availability notice on February 12, 2026, stating that 1-ounce silver coins and 1 kilogram silver bars are experiencing extended production and shipping delays due to, quote, unprecedented order volumes and raw material sourcing constraints, end quote. Perth Mint, one of the oldest, most well-capitalized mints on Earth, is telling you they cannot source enough raw silver fast enough to meet demand. At the same time, the paper price dropped. Let that sink in. The Royal Mint in the United Kingdom updated its website on February 14, 2026. Britannia silver coins, 1 ounce and 10 ounce, listed as out of stock with no restock date provided. The Royal Mint, Britain's sovereign mint, out of stock, no restock date, while the paper price falls. Let that sink in. SD Bullion, one of the largest online silver dealers in the United States, posted a notice on February 15th that premiums on silver rounds have been increased to $4.50 above spot, up from $2.80 just 3 weeks ago. That is a 60% increase in the premium within 3 weeks. When a dealer raises premiums by 60%, they are not being greedy. They are telling you they are struggling to source the physical metal, and they need a higher price to justify buying it at whatever their suppliers are charging. That gap between the paper price and what you actually pay to hold the metal, that gap is widening. Let that sink in. But it gets worse. The Shanghai Futures Exchange, the SHFE, is showing silver for immediate delivery at a 6.8% premium above the London spot price right now. 6.8%. That means buyers in China are willing to pay $2.37 per ounce more than the official global benchmark price just to get their hands on physical metal today, rather than waiting. When Asia is paying a 6.8% premium above London, and COMEX registered inventory is draining at 12 million ounces in 72 hours, and Perth Mint cannot source raw material, and the Royal Mint is out of stock, and US dealer premiums are up 60%, you are looking at a global physical shortage. That is not a regional anomaly. That is not one mint having a bad week. When 5 separate institutions across 4 continents are all experiencing the exact same problem at the exact same time, that is not coincidence. That is a structural supply crisis. Now let me tell you who is doing the buying. This is perhaps the most important part of this entire video, because while retail investors in America and Europe are looking at a price chart that shows silver dropping and thinking maybe they should wait for it to go lower, someone else is not waiting. The COMEX delivery data for February 2026 shows that the entities standing for delivery and pulling physical metal out of the system are overwhelmingly classified in the swap dealer and producer/merchant categories. These are not retail investors. These are not small funds. These are industrial end users and large financial institutions with physical delivery obligations. They are not trading paper. They are taking the metal and walking out the door. Meanwhile, the short side of the COMEX, the entities suppressing the paper price, the ones selling futures contracts they do not have the metal to back, those positions are concentrated in a small number of large banks. The 4 largest commercial banks hold a net short position, equivalent to approximately 280 million ounces of silver, as of the most recent Commitment of Traders report from February 11, 2026. 280 million ounces short. And registered inventory just dropped to 267.4 million ounces. Let me say that again so it sinks in. The banks are short more silver than currently exists in deliverable form on the COMEX. They are short more silver than they could physically deliver, even if they emptied every registered vault to zero. American banks are short 280 million ounces of paper silver. Meanwhile, the People's Bank of China added to its strategic silver reserve for the fourth consecutive quarter. Meanwhile, India imported 14,800 metric tons of silver in 2025, the highest annual import figure in the country's recorded history. Meanwhile, Russia and Iran formalized a bilateral commodities agreement in January 2026 that specifically includes physical silver as a settlement mechanism. One side is holding paper, the other side is accumulating the metal. One side is playing a video game, the other side is taking home the prize. This is not new. This has been the pattern for as long as I can remember. But the velocity of it right now, the speed at which it is accelerating, is unlike anything I have tracked in recent years. Let me show you the technical indicator that most people are not watching. Silver lease rates. When you see the word lease rate in the context of precious metals, here is what it means. It is the annualized interest rate someone must pay to borrow physical silver from a vault and use it, typically to fulfill a delivery obligation or to suppress a price. When lease rates are low, it means there is plenty of silver available to borrow. When lease rates spike, it means the physical silver available to borrow is drying up, and lenders are charging a premium to part with it, even temporarily. The 1-month silver lease rate as of February 17, 2026, stands at 4.3% annualized. In November of 2024, it was 0.6%. In May of 2025, it was 1.1%. In October of 2025, it was 2.4%. Today, it is 4.3%. That is a 616% increase in the cost to borrow silver in 15 months. That is a panic signal. When lease rates move like that, it tells you the entities that normally have silver to lend are pulling it back. They are not lending it anymore because they need it themselves or because they do not trust that they will get it back. A 4.3% lease rate in silver is the market screaming at you that the physical is gone. Let me connect all of this together for you. What we are witnessing is not a silver price story. It is a silver inventory story. The paper price of silver dropped to $34.80 this week. At the exact same time, physical silver became harder to buy, more expensive to acquire, and more difficult to borrow than at any point in the last 14 months. COMEX registered inventory fell to its lowest point since 2021. Lease rates spiked to their highest level since late 2024. Sovereign mints across 3 continents are reporting raw material shortages. The entities who know the most about physical supply, the industrial users and sovereign institutions, are buying aggressively. And the entities who are short the paper market are now short more ounces than exist in deliverable form on the COMEX. What we are witnessing is a system that is approaching a forced reconciliation between what the paper market says silver is worth and what physical reality says it is worth. I believe we are approaching that breaking point. Not approaching it as in years from now, approaching it as in the structural pressure is building right now, in real time, and the drain we saw this week is not the end of that process. It is the acceleration of it. Now let me tell you what this means for you. I'm going to be very direct here, no sugarcoating. If you are currently holding physical silver that you already own, the single most important thing you can do right now is nothing. Do not be rattled by the paper price drop. You are not holding a paper contract. You are holding a tangible asset in a world where that asset is increasingly difficult to source. Your silver is worth more in terms of real availability right now than the $34.80 price suggests. Sit tight. You are positioned correctly. If you are holding silver ETFs or paper silver instruments, you need to think very seriously about what you actually own. An ETF or a paper contract gives you exposure to the price, but when a system reaches the kind of stress we are describing, price exposure is not the same as owning the metal. The premium you are seeing at dealers right now, that $4.50 over spot, is the physical market telling you what silver actually trades for when people want it in their hands. Your paper instrument tracks the suppressed price, not the real price. I am not telling you to panic sell your paper position. I am telling you to understand the difference between what you own and what you think you own. If you are looking to buy physical silver right now, here is the reality. You will pay a premium, probably $4 to $5 per ounce above spot at most reputable dealers. You may wait 2 to 4 weeks for delivery. That is the real market. Do not let the wait time scare you. The wait time is the signal, not the problem. The wait time is the market telling you that demand is exceeding available supply. Buying into a tight physical market has historically been correct, not wrong. But buy from established, reputable dealers. Verify before you wire money. And take delivery. Do not leave it in a pool or allocated account at an institution you cannot independently verify. Some people will say this is conspiracy theory. Some people will say the COMEX has always functioned this way, that lease rates spike and normalize, that mints have inventory cycles, that the big bank short positions are hedged. To those people, I say look at the evidence. 12 million ounces drained in 72 hours. Lease rates at 4.3%. Perth Mint citing raw material sourcing constraints. The Royal Mint out of stock with no restock date. SD bullion premiums up 60% in 3 weeks. Shanghai paying 6.8% above London spot. India importing record silver in 2025. The 4 largest commercial banks short 280 million ounces against 267 million in registered inventory. That is not conspiracy. That is data. That is facts. That is reality. You can hold each one of those data points individually and debate it, but you cannot hold all of them simultaneously and call it normal. Let me show you the bigger picture, because what is happening today did not start today. In January 2021, the Wall Street Bets silver squeeze pushed the spot price to $29.42 in a matter of days. COMEX responded by raising margin requirements. Registered inventory at that time was over 150 million ounces and considered healthy. Today, it is 267 million ounces, nominally, but the short position against it is 280 million. In 2022, when industrial silver demand from the solar sector was first being widely recognized, global silver demand exceeded mine supply by approximately 237 million ounces. The deficit was filled from existing above-ground stocks. In 2023, the deficit was estimated at 140 million ounces. In 2024, revised figures put the deficit at 182 million ounces. And 2025 preliminary data from the Silver Institute, published in January 2026, estimates another structural deficit of approximately 215 million ounces. Think about what that means. Think about a bathtub with a drain that is slightly larger than the faucet. Every year, a little more water drains out than flows in. The bathtub is not empty yet, but every year it gets a little shallower. And the people who know this, the people who track this professionally, the sovereign institutions, the industrial users, the entities pulling metal off the COMEX right now, they are not waiting for the bathtub to run dry before they act. They are acting now. This is not a short-term issue created by 1 week's trading activity. This is a structural problem 5 years in the making, and the data we saw this week is just the latest and most acute expression of it. Now let me tell you what I believe happens next. The banks holding those 280 million ounce short positions have 3 options, and none of them are good for the shorts. Option 1. They find enough physical silver to satisfy the delivery demand that is accelerating right now, which becomes harder every week given the inventory situation. Option 2. They pay cash settlement to entities demanding delivery, which is legal but increasingly difficult to hide and increasingly interpreted as a default by sophisticated market participants. Option 3. They begin covering their short positions, which means buying back the contracts they sold, which means upward price pressure. History shows that when silver short squeezes reach this level of physical stress, the resolution is not slow or gradual. The January 1980 silver run took the price from under $6 to $49.45 in approximately 14 months before the COMEX changed the rules. I am not saying 1980 will repeat. The market structure is different. The regulatory environment is different. But the fundamental dynamic, a concentrated short position meeting accelerating physical demand in a structurally undersupplied market, that dynamic is the same. The question is not if the paper price reconciles with physical reality. The question is when. And the lease rates, the inventory drain, and the simultaneous global physical premium suggest that when is closer than most people think. Now, there are 3 types of people watching this video right now. The first type is scared. They saw the price drop to $34.80, they own silver, and they are wondering if they made a mistake. If that is you, I want you to go back and watch the first 10 minutes of this video again. The price drop is not the story. The physical drain is the story. The second type is confused. They have heard about silver manipulation before and they half believe it, but they do not know what to do with the information. If that is you, start small. Understand the 2 markets. Understand the difference between paper exposure and physical ownership. Make decisions based on the data, not the price chart alone. The third type already understands. They have been watching this for years, they own physical, and they are watching this week's events with a very specific feeling. Not fear, recognition. Which type are you? Tell me in the comments. I genuinely want to know where you are in this process. The paper price of silver crashed to $34.80 this week. During that same week, 12 million ounces were physically drained from COMEX registered vaults. Sovereign mints on 3 continents reported stock shortages. Lease rates spiked to 4.3%, the highest in 14 months. The Shanghai premium hit 6.8% above London. U.S. dealer premiums rose 60% in 3 weeks. India imported record silver in 2025. The 4 largest commercial banks are short 280 million ounces against 267 million in deliverable inventory. One of these things is a lie, and it is not the physical evidence. What you witnessed this week is what manipulation looks like. Not manipulation as a word, as an accusation, as a theory. Manipulation as a measurable, documented gap between a paper price being pushed downward and a physical market responding in the exact opposite direction. You now have the data. You now have the framework. You now understand the 2 markets, the lease rates, the inventory drain, the geographic flows, the short position math. You get to decide which side of that gap you want to be on. The side that reads a price chart and calls it reality, or the side that reads the physical flows and understands what is actually happening. If this video gave you something no one else was showing you, share it with one person who needs to see it. Drop your question or your type in the comments below. And the next time you see a silver price drop, you will know the first question to ask is not, why is the price falling, but where is the metal going? That is not a market. That is a magic trick. And now you know how the trick works.